Most of our competitors are on Stripe. We're just exceptionally technically proficient. And so we built out our own entire Payfac as close to the legal line as you can get, but where we control basically all the rails. Like Stripe is an out-of-the-box product. If you're looking for a way of billing, but you just have to use whatever products Stripe gives you. That's it. And when you build it the way that we built it, we can do a lot. So we have full control over holding payments, dispersing payments, anything that we want to do around disabling payments for a merchant. We control our own fraud controls, our own ID verification. So this gives us the flexibility to develop instant deposit, merchant cash advance, different types of products.
Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Paul Hoeper, the founder and CEO of InvoiceASAP, mobile invoicing and payments software. He got started way back when in the early days of cloud and mobile and payments, and has suffered all the challenges and opportunities of being a little guy in early market and dealing with giants, and is now on solid ground with a great payments infrastructure, a valuable product, and growing solidly and efficiently as a practical founder. So we talk about all of that with the evolution of payments and the business models and technologies involved with that, in the modern practical founder game. It's a great interview with Paul. Hey, Paul, welcome to the Practical Founders Podcast.
Thanks for having me.
Yes, we've had a couple conversations already about your InvoiceASAP business. Do you call that a fintech business? I know it's an app that does invoices and gets payments and so forth, but
yeah,
is that clearly in the fintech? Maybe it's less plumbing than app, but
I would say that we are definitely OG original gangster fintech, like fintech before it was fintech.
Yeah,
So,
with all the slings and arrows,
yeah, I mean,
in the early
we
days.
did present at Finovate, so I think that
Right.
qualifier, right?
Yeah, great. So, and not many fintechs, as we were just talking about, have been bootstrapped through the years, but you've played this game because it's a different game than the traditional B2B SaaS in the payments world, playing that kind of thing. So we'll talk about that. Where in the world are you, Paul, today?
I'm in Incline Village, which is on the northern tip of Lake Tahoe.
That's getting to be a fancy place. It used to be less fancy, but
It is a tech hotspot. There are a lot of founders who live in the area, but they're usually founders of giant publicly traded companies. So
with their giant buildings on the lake, probably.
right,
Something like that.
giant
That's awesome.
estates.
Yeah. Did you start the company up there, or were you in the Bay Area, or where were you back then?
The genesis of InvoiceASAP was actually in New Orleans,
Okay.
Louisiana.
We'll get to the genesis story here as well.
Yeah.
What's the current state of the business? Can you describe what is InvoiceASAP? What does it do, and who is it for these days?
Sure. So InvoiceASAP is a very easy to use field service invoicing and payments platform for home service pros. And so we service about 23,000 what we refer to as premium accounts. So these would be accounts where we are monetizing either through legacy SaaS or through our embedded fintech model under which the software is actually free. So we have about 400,000 users who use a free version or a dormant version of the app. So it's a significant user base and it continues to grow, in the 20 to 40% a year. And, our biggest verticals are HVAC, plumbing, any kind of contractor, landscaping, roofing, all that good stuff. Anybody that comes to your home to perform any kind of repair or sale.
And can you give us a view of roughly the revenues and number of members on your team these days?
Yeah. So InvoiceASAP is going to come in right around just under 3.5 million in total revenue. And right now we are a team of 12.
And you sell mostly in North America, presumably.
That is correct. So the U.S. market is probably about 85% of our market. Our number two market is the U.K.
Oh,
where
there you
we
go.
don't offer any fintech solutions, but you can pay the SaaS fee. Number 3 is Canada. Number 4 is Australia, and then strangely enough, like number 7 is Latvia. Uh, yeah,
Okay.
we're only localized to American English,
Yeah.
and, while we do have aspirations to localize to, sort of like the UK version, which we will do, and then further aspirations to localize to Spanish. But yeah, our core is the US market.
And it's a mobile app, so I guess it's found in the app stores, right? So people all over the
Mhm.
world can find this. Is that right?
Yeah, so it is available in every app store. We support every single currency globally. It's available in Google Play and the Apple App Store.
Okay,
And
so people
then
everywhere can find it, and if they like an American English thing, and presumably it handles whatever currency they
that's
care
correct.
about. What's a typical use case for this here? So we know about payments, we know about Square and, getting a credit card when somebody does our HVAC and so forth. What is the use case for an invoice that's different than the swiping a card or tapping a card?
Yeah, so interestingly enough, InvoiceASAP was actually the original invoicing solution for Square.
Oh,
Right?
yeah.
And so, the idea is and we were also the original invoicing solution for Clover, which is a point of sale. The real difference and why there would be invoicing and what invoicing is sort of all about is, if you have a point of sale, you're taking a payment immediately upon the delivery of service or goods. And you can certainly do that with an invoice.
Yeah.
But where invoicing comes in and estimates come in is, maybe when there's a little bit of a sales cycle
Mhm.
that the home service pro has, or there might be partial payments, but it's really tracking a more in-depth transaction than just a counter walk-up. So
Right.
there's a customer management aspect of it, certainly an inventory management aspect as well, and an AR management, right? So that
Yes.
that when you have these invoices
Collections.
that are
Yeah.
out there floating around, the whole idea is that the faster, the easier you make it to get for your customers to pay you, the faster they will pay the invoice. And we sort of make that easy in a number of ways. So we have tap to pay on the available on Apple and Android phones, and we have payments box that's integrated into the digital invoice that can be viewed either in email or on your phone. It's slightly different layout, but it's all about conversion for the home service pro.
I'm presuming you do a ton of integrations with all kinds of payment methods and all kinds of accounting software, and I don't know what else, all kinds of
Yeah.
home service
So
software. Yeah.
yeah, we used to I mean, when we first started, we were payment agnostic, right? And
Ah.
so when we first started, we kinda integrated to everyone, and our 2 largest integrations at that time were Square and Clover. But we allowed anyone, to attach a payment method to, Invoice ASAP. We no longer do that.
Ah.
Now we effectively own our own payment rails. Without going too much into it, we are as close as you can legally be from a regulation standpoint to the line before we would have to be a registered Payfac. So we do sit on top of a pretty fantastic acquiring platform, which is Audion. We have moved ourselves, you know, all the way to the point where you don't recognize. I mean, it is just basically the product is Invoice ASAP payments. Moving on to accounting, we currently integrate with QuickBooks Desktop, going all the way back to I think
Oh my
2008
gosh.
version, and we integrate with QuickBooks Online, and we integrate with Xero, and that hits in the 90-ish percentage of all SMB software in North America. Further on down the line, we can maybe take a look at some of the Sage products, for
Yeah.
Europe. We've looked at that in the past, but, there's plenty of work to do for us in the US market, etcetera. We can support custom integrations and Zapier integrations, etcetera, and the integrations that we have, moving forward, in the next 6 months or so will include some AI agent integrations. We're not developing our own AI agents or anything like that. There are plenty of incoming call, inbound sales call, scheduling agents that we can integrate to, and some of them are even specialized to the
Mm.
home service trades.
Sure.
So companies like Broccoli and
Yeah.
Evoke have really come a long way and they offer integrations and we'll provide those.
Well, the home service software market has come a long way, and now for the in real life kind of conversations, the AI and, doing some of the magic that software never did for that industry. And payments has come a long way. And, your business has evolved through this and managed to keep going with all the massive changes in payments and everything else. Well, you've been doing this a while. This was, you say you were there at the beginning of fintech. This isn't something you made up last week when home services started to, evolve into a major tech segment. You've been doing this a long time. When did you get this thing started?
So I was actually running business development at a company called the Receivables Exchange, which was headquartered in New Orleans. And what we built was like an eBay for business receivables. And it was successful. And we were, we were one of the only companies that were able to raise VC financing during the Great Recession. And so I was just, right in the thick of that, talking to the software providers like Ariba and Intuit and QuickBooks and all those. And one of the things that I always wanted to do that I couldn't figure out why it wasn't available is I kept saying to myself, why can't I create an invoice on my BlackBerry? See, this is before the iPhone,
Yeah, yeah.
for iPhone and Android. And I was like, well, why can't I create an invoice on my BlackBerry and post it up to the Receivables Exchange? And then that kind of graduated to why can't we have an invoice payment go from the Receivables Exchange into Intuit, into QuickBooks, right? And this is right before QuickBooks Online launched, to give you an idea. And so, I left that company right after they raised very successful C round. And this was right after the App Store came out. The Apple App Store had launched. So this is over several years, right?
Yeah.
So I left the company and, pretty much the next day started working on Invoice ASAP with the idea that it would be an add-on. It would be the mobile extension for a platform like FreshBooks, right?
Yeah.
It would be a mobile extension for the supplier network of Ariba. And then separately, I started to develop a QuickBooks desktop integration.
Mhm.
QuickBooks Online had just come out. There weren't even APIs for it. And at the time, I actually met with Rene Lacerte, who was the founder and current CEO of Bill.com. And he very directly told me, you know, build all your own connections to Intuit, to any Intuit product. Don't rely on anything Intuit produces. So we built our own integration to QuickBooks Desktop, and I kind of went around, selling that as a separate license. And then, the light bulb sort of went on that these two things should be the same thing and that the platform should be a standalone platform for estimates, invoices, customer management, et cetera.
How
And
long
so
did it take you? So this is a practical founder kind of
yeah,
question. Everybody's got a different journey, but for somebody new out there or in the modern AI wave, right, I have this idea. I know a space, I see a hole, and I'm going to go after the hole and I'm going to start
yeah.
exploring there.
I was still in New Orleans. I was working from my apartment, and it took about 10 months probably to get the working app integration to QuickBooks, sort of combined together. And this was, by the way, this all started in 2009. So this is
Yeah.
2010,
Beginning
and
of
then
cloud and mobile and
yeah, this
fintech.
is all beginning. I mean, they didn't have. I mean, part of the story is we actually were TechCrunch Disrupt finalists in the New York
Yeah. For
2011
all the new cool kids
Battlefield
coming out
class.
with
Yeah.
the internet web 2.0, right? We
Yeah,
would
and
say.
there just wasn't I mean, there just weren't the tools. So, as an example, when, we finished with the TechCrunch Disrupt and we moved to Emeryville. Well, now it was a we. I brought on a co-founder
Yeah.
and Maxwell at this time, so it was the 2 of us, and there didn't exist like, this was Zendesk was just,
Yeah.
getting going. There was not a way to manage subscriptions. We had no idea how we were gonna collect payment
Yeah. All that
at
beginning
this
stuff.
time. There was only one company that really did it, which was, Zuora.
Right. Yeah.
So this is before Recurly. I mean, we were like, "Well, what are we gonna charge? How are we gonna get paid? How are we gonna accept payments for this?" And we were lucky enough to be one of Recurly's the founder of Recurly through a friend or a landlord actually in the San Francisco area, and that out of luck, that is how we were able to, start taking in our first revenue, and the app didn't get listed in the App Store until August of 2011.
So it took a while, but you kind of figured out the space, and it was like, the mad gold rush, people running out to create apps and new things,
Yeah, it was very
cloud and
yep,
mobile and, global was happening. Social media was exploding again. Facebook was taking off like a new frontier, like we see with AI these
yep.
days. I don't know. It's a frontier. That's maybe the only analogy, and everything's cheaper, faster, bigger, cooler, and all the rest of that. But you had the vision to sell this as like we would say a SaaS app now, right? Charge a fee for it, recurring revenue, and probably not charge for the transactions. A lot of fintech is the opposite. We don't charge you anything. We'll take a piece of the transaction, that percentage of a percent. Was it SaaS based in the beginning? Like,
Yeah, so we were SaaS based on using Recurly as for our SaaS, and we were available. We were one of the very first integrations available in the Square, what was to become their app store, and then also on Clover. And so those were our distribution partners. And in 2017, the whole time we were talking to really large payment platforms, and everyone wanted us to build a Payfac. So WorldPay had this Payfac program at the time, and that's sort of what all the cool kids were doing.
so
Is
they
you
had the deepest plumbing and they wanted
Yep,
you to do the next layer up.
yep,
Yeah.
and it
Payment
was super. I
facilitation. Yeah.
mean, we were talking, kind of mega. It's basically like building your own Stripe or Square, right?
Mhm.
And because those are
Didn't
both
exist.
Payfacs.
Yeah.
And what we thought as our thesis was, and this was probably 2014, 2015, we said, Payfac as a service will be a thing. It will be a thing where you can get everything to operate as a Payfac that you need in order to get a piece, get on the inside of the interchange fees and move your business model closer to a Stripe or a Square. And we were right, but really, in 2017, the products that were supposed to be Payfac as a service, they kind of really weren't. They missed a lot of functionality, et cetera. So we, in the
That's a
course,
bumpy time for
yeah,
all the
this is a very
payments
bumpy
guys,
time.
right, and I
Yeah,
think
and every
we're
I'm just
probably
gonna
on
go
the other
through it.
side of it now. That's why Stripe was an advantage for a lot of
Yeah.
people. They put modern, secure, how should we say this? They did what
Oh,
they
I'd say
said they would
easy
do,
easy to use
easy.
integrations.
Yeah,
Easy to
right.
use
There was a lot of
integrations. I mean,
hucksterism in this tech.
yeah, most of our competitors are on Stripe. We're just exceptionally technically proficient, and so we built out our own entire Payfac as close to the legal line as you can get, but where we control basically all the rails. And in 2017, we
What
flipped
does
our
that
model.
mean for non-fintech founders? Like
So
the deeper you go in the plumbing, the more
yeah,
control you have over your world or something like that, or?
yeah, a lot, a
Yeah.
lot. So really, the best way to say that is like Stripe is an out of the box product. If you're looking
Simple
for a way of
API
billing,
at the top, yeah.
but you can't really do like you just have to use whatever products Stripe gives you. That's it. When you build it the way that we built it, we can do a lot. We have full control over holding payments, dispersing payments, anything that we want to do around disabling payments for a merchant. We control our own fraud controls, our own ID verification, where we actually use Plaid for that. But we use very advanced ID ver technology that is available from Plaid. And the other thing that allows you to do, if you're us, it gives you the best way to refer to it is a split pay functionality. So what we can do is we can actually control how much of a particular payment settles to a merchant even after the payment was accepted. So this gives us the flexibility to develop instant deposit, merchant cash advance, different types of
Buy now, pay
products where we
later kind of
yeah,
thing? Yeah.
well, no, not so much buy now, pay later. That's really separate. But it allows us to offer certain types of financial products where we can advance money to a merchant, to a home service pro, and we can arrange the pay down of the advance via a split of their, future.
This episode is brought to you by my friends at LaunchPay. LaunchPay is built for B2B software companies where client onboarding is hands-on and messy. Think data collection, setup steps, approvals, training, and customization. If you're currently juggling onboarding through email threads, spreadsheets, shared docs, and way too many check-in meetings, LaunchPay pulls all of that into one clear system. It gives both your team and your clients full visibility into what's happening. It automates follow ups and approvals and helps you onboard customers faster without adding more people or process overhead. Hundreds of practical software companies use LaunchBay to deliver a consistent, professional onboarding experience every time, so customers get value faster and teams stay sane. You can check it out at launchbay.com/practical and get 25% off the first 3 months of any LaunchBay plan. Now back to our podcast. And is that
A
the main benefit is you get to create these fintech products when you have that
lot more control.
control? Yeah.
Yeah, a lot more control because the other thing is, what you find, and this is absolutely true, is that, payments companies are payments companies. I mean, even Square, which now has their own invoicing, capability, but payments companies think about their products just only as payments for any kind of customer. And we serve the home service market, right? The home service pros. And so what we do is we design our products specifically, every aspect targeted for how a home service pro
I see.
would use that.
Yeah.
So a really great example would be Stripe and Square both have capability to advance on a merchant cash advance, and it is like 9 to 18 months of a pay down. Well, home service pros, these guys really want much shorter term product, a week, 2 weeks, 30 days, and it's not something that just pops into
Yeah.
that payments company's idea. They just think, oh, well, cash flow management for everyone. But home service pros, these guys are always looking to employ capital to start new jobs. They're constantly waiting for a job to pay, and they're immediately taking those funds and rolling it into the next job. And if we can step in and provide that capital for them in a much shorter term basis, this is just probably the best example of why you'd want to build some of these things yourself. And not everybody. I mean, for us, it was chasing a dream that we had of getting to the point where we are now, where we do have the kind of margins and payments and have the kind of control of a product where we're not at the mercy of a platform forcing us to use things a certain way or discontinuing certain things that we might be relying upon,
Yeah.
or changing things from a maintenance standpoint where all of a
Mm.
sudden we have a fire drill to update standards to meet someone else's technical requirements. These are things that we wanted to have. It's probably not best for everyone. I mean, if I was starting today, I would go to Stripe first and, use their product. But, the reality is if you're building a business model that's focused on the margins within the
Yes.
payment space,
Transactions, right.
you gotta build it yourself because no one else like the more you build and control, the more of that margin you get, right? The more you build and control, the more you get of that margin. And you have to participate in the risk too.
Have you changed your business model from the beginning was SaaS fee and you could do payments on it, and now it's free with payment? We'll take a little
Yeah,
piece
that
of the
was
payment? Yeah.
that was 2017 when we were first looking
Okay.
when we first started using some of the earlier Payfac as a service platforms. We stopped marketing our SaaS.
I
So
see. Okay. Right.
now when you onboard to Invoice ASAP as a new merchant, as a home service pro, our sales guys and all of our materials are very focused on getting you across the payment application threshold. And when you do that, Invoice ASAP is completely free. So
Yeah.
we don't charge any SaaS, and we rely on a basis points business model that's a combination of credit card and ACH payments, instant deposit, which we charge a fee for, merchant cash advance, buy now, pay later, which we offer in the platform via third party integration, and credit lines,
Yeah.
right? And you can still hit our SaaS. Like if you don't want to use us for payments, we'll let you create 20 invoices a month, and then you will eventually hit a paywall. But it's our SaaS business has been like flat to 1 to 2% growth, and our payments business, has growth rates that range in any given month between 27 and 40%
Yeah.
year over year growth, right?
Well, that's a much different business, right? And VCs tend to like the steady SaaS revenues, especially after COVID when transactions went down. But we're back to transaction world in AI with tokens and consumption and outcomes and usage and all of that kind of thing. What does maybe I don't know what it was. Maybe it was $100 a year for your SaaS app back in the day. What kind of revenue do you make for a customer these days in taking the little, let's say, the pennies on the
Right.
dollar? You know?
Right. So originally the SaaS was like we had a single owner operator plan that was $3.99 a month, or we give it to you for a year for $24.99.
Yeah.
And
Okay.
then, like the full-blown premium version was $14 a month basically per user. And we averaged out what our SaaS was. Average revenue per user for SaaS turned out to be about $9 a month. So, and then where we are now, only on our payments, not even
Right.
including anything else, is we fluctuate between, 80 and $94 a month
Oh my
um,
gosh.
per merchant. So it up quite a bit
Per customer. Yeah. Or
per
per
yeah,
user, I guess you'd
per
say.
per business
Yeah.
user, per
Okay.
business
Okay.
account.
Right.
Yep.
Okay. So it's not users, it's business account and
Yeah, it's
maybe
per business account. That's why we average it. And typically, you know, we have a ton of single owner operators that are on the platform because I mean in the 10,
mostly like that. Yes. Right. Yeah.
well, because we don't restrict them from signing up. But our sweet spot is like the 5 to 10 person company with like 3 to 5 trucks in the field.
Yeah.
On the high end, we kinda top out at 30 trucks in the field, not because we can't support more,
Mhm.
but at that point, they're sort of outgrowing the
The
core
math.
capabilities of
Okay.
InvoiceASAP and probably graduating to something like a Service Titan, right? Which is really the enterprise version, right?
So, were you excited about going off of SaaS to the more transaction,
Yeah, we
fintech
were well,
model?
we
You
we
wanted to
saw
go that
that
way. Yes, right.
total holy grail, right? And initially and like I said, we went through we actually went through 4 different payment platform partners
Oh my gosh.
on the Payfac as a service in 5 years, right? So
That's
we
major
so
plumbing,
yeah,
infrastructure. Yeah.
and it would make a great movie, but it was sort of just like one thing after another, right? Whether it was partners falling short on technology or programming or ethics. The payment industry itself, I give it about a 3 on the ethics scale. I mean, there are some really, really, you know, good actors, and then there's some really, really horrible actors in the space. And,
It's not
everybody
just about they're huge and
some of them are
whatever.
giant. I mean,
And
some
and
of
you're
these are
small, right?
yeah, some of
So
these are publicly traded companies, and I won't go into, who they are, et cetera, but it's just very surprising, you know?
yeah,
So, I mean, of the good actors, Square's a good actor, Stripe's a good actor, Audience an excellent actor, but there's a lot of everybody wants a piece of that transaction business, and most of it is very, very old school traditional merchant account technology, and boy, are they trying to put a lipstick on that pig.
yeah,
Like, I mean, it is, barely able to transact a transaction modern world-wise, and the leaders are really Square, Stripe, and Adyen. Everybody that built something from the ground up and didn't use, connecting new stuff to really bad old plumbing, right?
yeah,
And you see this shake out now. I mean, like what you've seen with FIS and Fiserv and Global Payments is they're just shuffling around basically the same executives and, you
yeah,
know, buying and selling the same companies from each other. And TSYS is one of them. TSYS is part of Global Payments. And this is just all very old stuff. Is it going away? No. Is it growing? No, right? Those platforms aren't growing at all. And the things that are growing are using the newest stuff. And by newest stuff, I'm not really getting into stablecoin stuff or anything like that. I'm just talking about the velocity of money as it relates to uh, processing credit card and ACH transactions. Just that, right? And the fact that Apple Pay is, or not Apple Pay, that Tap to Pay
yeah,
is available on Apple and Android phones, just like you do at a gas station or the
yeah, uh-huh,
supermarket.
yeah,
So, we have tap to pay in our app so that our home service guys can just, hold the phone and their customer can tap their credit card and they're paid. Well, you'd just be really surprised at how many platforms don't and never will support tap to pay, even though they claim that they're working on it. They kind of painted themselves into technological corners,
Mhm.
right? Where because of the decisions or the platforms that they're built off of or using, they'll never be able to support Apple Browser Pay, Android Browser Pay, Tap to Pay, or support an instant deposit product. Like right now via Adyen, we can move money instantly to a merchant's bank account 24/7, holidays, etc., using both FedNow and real-time payments,
Huh.
right? And in order to use those, to use those anybody can use them, but to use them in conjunction with a pending payment, like something that has been swiped, but it hasn't settled yet, right? We are, by the way, I think, the only platform that offers instant deposit versus an ACH transaction. So
Wow.
if you yeah, ACH is a little slower to settle, and they can be charged back, up to a month after an ACH has been taken. So to do those kinds of things, you have to have something new, right? That's
Yeah.
built on brand new, or you have to use a piece of hardware. And we are absolutely against you know, distributing hardware to our, service pros, like, "Oh, let me go
Yeah.
get the thing in the truck," or "I forgot the thing," or "It broke," or "It's missing," or whatever. And that was, by the way, a nightmare too. Like, we originally, for several years, everyone wanted to use a dongle, not
Sure.
not unlike Square's dongle or a chip reader, but then the hardware was always changing. So, like, the new Android phone coming out every month, and, Apple is always changing its inputs, Lightning cord, USB-C, all that. And then finally they came out with something that was, Bluetooth, but then there were security issues. So flushing all of that down the toilet, was a great thing and really freed us up. There are a lot of our competitors and a lot of those older, payment platforms, they're still using that stuff. They're still using it, and, that's where they lose the race and we win, right?
Canada has different, banking regulations and credit card fees, and they don't have the same kind of ACH. It goes direct transfer with the different fees. There's a lot of regulation, fees, right? Big banks and government and so forth. You go to Europe, it's different. Do you think the big question here, do you think that the US fintech plumbing will get cleaner, faster, updated? There's a lot of regulation and regulatory capture
Yeah,
preventing innovation, but do you think we're gonna get a cleaner, cheaper
I
infrastructure?
do.
Okay.
Yeah, I do, and what I'll say is, like, what we're using now, um, we can very easily turn on payments in 32 different currencies. So,
Right.
we can replicate. We're not live for payments in Canada yet, but Canada, UK, and Australia,
But there's
are
not some regulation wave or deregulation
Tho
wave
those are
coming down
those are
for
the
payments.
3 those are the 3 that are most like the US market.
Okay.
Once you get out of the US market, it's not even a deregulation thing that's the issue. It's more of like a much more strict regulation on
Ah,
tax.
yeah.
Like, Brazil is a nightmare,
Oh,
as
wow.
an example. And EU, Spain, Italy, France, not only are there EU regulations that sit on top of it, but there are also individual country regulations.
Yeah,
So
right.
it's actually more of a spaghetti monster on the EU side, and the sort of easier to produce products is the US, Canada,
Okay.
Australia, and UK for our current business model. When we do eventually localize and start doing some stuff in euro, it's very unclear if our business model around payments will even work. We may have to
That's
go
right.
back to SaaS.
So you've survived the waves of this fintech, credit card payments, plumbing, right? In the infrastructure providers, the Payfacs and
Yep.
the payments and all these guys. You've survived all those waves. You're onto this. How did you get customers all these years and keep this thing going? If you're not making a ton of money, you're not doing a ton of expensive marketing. Are they just finding you in the app
Yeah,
stores and starting to use you like the
right.
free kind of thing?
So at the beginning, everything was organic. At the beginning, we were getting 250 to 400 signups a day just by sitting in the app stores, just sitting in the app stores.
Being the one of
And
the
then
few things at the app store in the early days, right?
yeah, I mean, well, and it was a real nightmare too, because the app stores were only used to seeing games and publications. So they were not ready for business apps at all. So like
Mhm.
they were very unclear about how a sign up would work
Mhm.
actually. And so in the beginning it was just the app stores and then Square distributing and then eventually Clover distributing. And
Meaning you are in their app stores.
yep,
Okay, so
yeah.
you're in all the marketplaces. Yeah.
Right, and but we were, like, first, right?
Yeah.
And when it still mattered. We no longer have partnerships with either Clover or Square,
Okay.
to be clear on that. But the other side of that is or rather what the way it is now, is that we do quite a bit of spending in Apple search ads.
Yeah.
So we do quite a bit of spending in Apple search ads, and that's been the most effective from a cost standpoint and then we do Facebook video ads and things like that. And you get a little better targeting on the Facebook side. In Apple, you can't really target for
Yeah.
size of business
Yeah.
or even vertical. And so you can target keywords and that's kind of it. And with Facebook, Instagram, probably TikTok, although we haven't done anything in TikTok or Reddit. And those two are coming up. I think we'll probably start exploring some things with Reddit and we're going to be posting a lot of content in TikTok. But really, you know, from a targeting standpoint, Facebook, I'm in town, and then
And then you direct them to the app store or
no, so we did that for a while. We do not do direct to the App Store, and there's a couple reasons for that. Apple makes it so difficult to tell, like, once a user is on your App Store page in Apple, once they download the app and that stuff, you've lost information on who they are. It's
Eh,
impossible to track through. Like once they have the app in their hand and they do the sign up on the app, if that's where they're signing up, you have no idea whether that was coming from a paid source or not. And that's
right.
true in Apple
It's
search.
terrible.
And
Yes.
it has been like that for kind of many years now. And it is really a nightmare for every marketing agent and
But
and
it's not
and
about the 30% that they're gonna take off the top of
well, that's only
their
if it's in-app that's only if it's in-app purchase. That's a
so that's
purchase
another
and then
reason you would go to the transactions. Here's a free app,
yeah,
and we'll get you on the backside.
right. I mean, you can hit in-app purchase, but in-app purchase kinda sucks also because you can't manage like, you can't do multiple users in in-app purchase.
Ah,
So, these are all things that we've fought with Apple, over the
another
years.
giant. You're fighting the
Yeah.
giants out there, Paul. Oh
Well,
my gosh.
we used to have a lot more fights with Apple,
Oh, yeah.
but our relationship, like, we don't even have a contact at Apple anymore, I don't think. But with Facebook, we do a form fill, a hand raise, a demo schedule, and we get that information into our
More about
CRM
control, right?
way more about control.
So s
And another thing, if I can plug
yeah,
something, which is a founder who you've interviewed, we last year or in the last year moved all of our HubSpot operations and all of our MailChimp operations, things that we were using for email, things we were using for sales and CRM, over to Go High Level. And this has just been an
for
amazing.
your internal sales and marketing
I mean,
system,
we knocked 90 plus $1,000 in savings off of our annual spend in there, right?
right?
I mean, probably over 100,000. And the Go High Level platform from a cost, I mean, basically for anybody who doesn't know this about Go High Level, it's a really interesting platform that functions in a lot of different ways. But what it will do for an unbelievable price is give you
A few hundred
very
bucks a
deep
month. Yeah,
yeah, $125 a month plus, like, some minor stuff. It will basically give you advanced functionality, advanced level HubSpot functionality, and advanced level MailChimp functionality
yeah,
combined in
yeah.
one spot. And
Yeah,
it
so you've
is
been lean and mean, and
yep,
you've worked with these big payment providers and, opted for the control, right? And you've been in the home services market. So speaking of control, did you ever get investors? And it sounds like you would stay away from that just because you wanna have
yeah,
your
we took on
independence, but yeah, but do you have
yeah,
outside investors or
we have about 22 investors on our cap table right now.
like friends and
And
family angels, or do you have any institutional?
friends, family, angels, couple professional angels, this
Yeah,
was TechCrunch Disrupt was when we were there doing that. It was right around the time that Y Combinator was kinda getting out,
Yeah, so
and
that
we
was
were picking up,
early
like
days.
we picked up a bunch of Y Combinator investors, and then, we almost got we went into due diligence to get acquired by one of the largest software companies in the world in 2014, at the same time that we were raising our first VC round. And at that time, we took in a couple small checks from individuals, and because we thought we were gonna get acquired, we stopped the raise, and we used that money to convert the convertible note investors into a very small,
So
um
they're long-term angels, right? They're wondering what
they're long
yeah. No, I'm
I
getting
mean,
it. Right.
no one's had a liquidity investment, I mean, a liquidity
Kinda
event.
redundant,
Uh,
long-term and angel, like,
yeah,
most of these
and
don't really go anywhere.
right,
Okay.
and we've been I mean, since then, since 2014, we have been 100% debt financed,
Oh, wow.
and it's, that's an up and down world as well. I mean, we've been through, several different lenders
Yeah.
over time, and
And
right
do you use
now,
that for operations or because of the financial flow that you have, cash
say
flow?
operations and scale and marketing, sales and
Okay, alright.
marketing, right?
Yeah, so
So,
yeah.
everything that we're doing now, I mean, our product is very mature. We have some major things that we wanna release, but there's not too many more major things that we wanna release. I mean, one of the
Yeah,
things we're very late to the game with is our scheduling and dispatch, and
yeah,
that is on the verge of being released, and then we're talking about, introducing a few other things that I'm not gonna mention because they're
yeah,
not on the market yet.
yeah.
But almost everything we do now is sales and marketing,
Yeah,
right?
of
So
course, you're back to the game. Enough
we do a
product to
debt
sell.
raise. Yeah, we do a debt raise. We lose money, we burn acquiring new merchants and new home service pros, and we dovetail into cash flow positive,
Start paying it
right
back.
around the time we run out of money,
Yeah, yeah.
and then we do it
Okay,
again, and then we do
yeah.
it again. So
And how big are those chunks, those debt chunks? I
it
mean,
it depends. I mean, the last one was 1,000,000. So we did a debt round for $1,000,000 last, September, August or September. We've done several chunks that were 500,000. We've done a couple chunks that were 300,000.
okay.
Yeah.
And, do you in Fintech, there was a lot of, yeah, you can't be big unless you raise money, and you knocked on the doors of, the venture capital world there. Do you regret not raising venture capital? Do you think it would have helped you? Do you
Yeah,
know
I
it would
mean,
have hurt you? What's your story
yeah,
on that?
I have a lot of takes on that. I have a lot of takes, and I've seen a lot of nightmares too, right?
Yeah, of course.
And so, I mean, something for every founder to understand really, really well that they need to understand is if you take on a professional institutional investor, someone
Yeah.
who's raised money from institutions, whether it be a
Yeah.
VC, growth equity is real big right now, et cetera, you will lose voting rights. So they will not give you a dollar without controlling the board, which means that gives them the capability to control a lot, right? They can control, you know, whether you exit or not, who you sell to, what the price is,
Who's the CEO?
and who's the CEO, right? So the biggest thing they can do is force out the president and the CEO.
Yeah.
That's really the biggest thing.
Yeah.
So, there's that, and then there's also something to be very aware of, which is an equity overhang, right? And so, a professional investor, a VC investor is going to be looking for, you know, a 10x return is a success. And there's some models that go 4x now, et cetera. But basically, the danger for a founder or for a founder team is if they force an exit, for instance, to private stock, or if they step in and control where you can exit.
Right.
So if you take in, 20 million for 30% of the company, that 20 million wants to be 200 million,
Yeah.
right? Which means you're getting close to $1 billion exit.
Yeah.
And $1 billion exits are hard. And
And rare.
so they're rare. So in some respects, in a lot of respects, if you can get away, I mean, VC money makes, again, it certainly means you can buy yourself into the market. It may come with a lot of connections and resources. It's not that there is money, but it's whose money is it?
Mhm.
That's another thing to consider. So if you've got, we have taken VC anytime up until 2016, 2017, I mean, we were still pitching at that time.
Yeah.
And we,
And that's what people did. And
yeah, we almost
especially
said,
at the
but a lot of people did, and I've seen founders who I know,
of course,
some
yeah,
who deserved it and some who didn't deserve it, get pushed out of the company they founded and lose all of their equity,
yeah.
right?
So you
And
were
that
just not up
happens.
for that game, right? Once you
I'm not
realized
up
what
for it
what
now,
yeah,
let's put it
right.
that way, right?
Okay,
I
great.
mean, and, like,
Yeah.
we would consider, what we consider when we think about exits, we get solicited all the time by smaller
Yes.
by growth private equity. They call it growth private equity.
Yes.
It's really growth private equity is really bridging
Yes.
from what private equity would be
Growth equity. Yeah,
and a
right.
VC,
Yes,
right?
right.
And most of the growth equity guys, they're really still working on a PE model,
Yeah.
right? They're gonna buy control of your company and
Not
then
as crazy as VC, but,
they just want they wanna run it for a beta, which is not how you run a software company, by the way,
yeah,
right?
yeah,
So if you're making money, why aren't you spending that on marketing and growing your user base, right?
yeah.
So everything that's been wildly successful in software typically hasn't been a beta positive until
Yeah.
acquisition or exit.
Profitable, right?
Yeah.
Like, SpaceX today, right? Not quite profitable, yeah.
Yeah, pretty
There we
crazy.
go. More venture style.
Right.
So where do you see this going, Paul? You've bought your independence. You've struggled through the
Yep.
challenges. You figured this out. You haven't moved your core proposition, invoicing or home services. You've moved everything else in the business, your business model, your payment infrastructure,
Yeah,
productizing, and all the rest of this. Where does this go from here
I
as
mean,
a practical independent founder?
right. So as I mentioned, I mean, we have conversations once a quarter with 5 or 6 different, you know, growth equity firms who, kind of are at the point of like when you want to bid, when you're looking for a bid for the company, call us. And
And do
so
they
we
wanna
have
buy your whole company or invest in you
it
to take it to
depends.
the
Yeah,
next
they usually
level?
those guys usually want to buy a majority, and then but a lot of them what they really want to do is they want to buy the whole thing. I mean, they structure
Okay.
it so that they end up.
But you're not there yet. You got some meat on this bone, and then
We
you
wanna scale more. I mean, we wanna
yeah,
scale, we wanna release there's products we wanna release, there's growth that we wanna be a part of. And then, as far as, like, if we were thinking strategic exits, a CRM, a payments company that doesn't have field service or invoicing software, a CRM would be a great exit for us. One of
yeah,
our larger competitors, maybe like a Service Titan. Guys, if you're listening,
yeah.
uh, we would cover the lower market. So there's kind of a couple places where it could happen. But right now, I mean, we're in a good place. Our
Yeah, good
merch
for
is
you. You've
happy.
bought your independence.
Yeah,
Yeah.
we got it going and it's working. So
And how is a company that's no longer, monthly SaaS revenue, credit card payments, the MRR game or ARR game, how is that your business valued differently than them? The payments game, right? Which is, let's say, less contracted recurring revenue, more
yeah,
reoccurring. We know they'll do
right.
transactions, right?
That's an interesting thing. So like we still have about 40%, 45% of our revenue comes in via some sort of SaaS,
Yeah,
right? Whether it's credit card or in-app purchase, et cetera. And then we have our fintech revenue. And
yeah.
really where we see the real difference that we see is when you go out to get debt, that
Ah,
there are a lot of debt providers who will only work with SaaS.
of course.
Okay. They're not even set up, even though the payments business is very consistent.
Yeah,
And in fact, for us went way up during COVID is because people
of
didn't want
course.
to make an in-person payment. And so starting 5 or 6
Yeah,
years ago, 6 years ago or so, you had a lot of these providers would only want to look at your SaaS. And we're finding now that more are looking at everything. They're doing a plat integration. They're looking at all your revenue in one bot rather than trying to split everything out. And
I
I think that
yeah,
makes a lot more sense. It's not like it's fluctuating, right? I
yeah,
mean, we're having record months right now for payments and number of merchants accepting payments and volume and all that, number of transactions, and it is not volatile at all. Like
yeah.
we're up 22% will be our June year over year on payments. This looks like I think May was 27%. I mean, it fluctuates a little growth-wise, but once these guys get in and start, doing business, I mean, the thing everybody worries about and has worried about is some sort of massive deep recession. And I feel like we're really
Right.
insulated there as
COVID,
well.
right? When transactions stop in
Well,
segments of the
yeah,
market, right? Yeah.
yeah, but COVID, I mean, we didn't know what was gonna happen.
Yeah.
We absolutely took off,
Ah,
because everybody was doing work on their houses because they were home, and nobody wanted to make a payment in person. They
right.
wanted to receive an invoice and make a payment that way. But what I'll say is we've never seen the only dip that we have is November through March, early March, which is winter,
Yeah.
right? So there's a seasonal dip
Seasonal. Yeah.
when there's snow on the ground in the Midwest and the East Coast, and
Okay.
and it's a seasonal dip. But other than that, even when Home Depot has come out and warned about, remodeling a couple years ago, like, "Oh, the remodeling market's gonna get hit," we didn't see our lenders paid attention and wouldn't, up their loans or re-up their loans during that time period, but we didn't see any kind of dip. And the one way that the home service market is very resilient is, in a recession, you might not get a new water heater, but you're gonna repair the one you have,
Yeah.
right? And so the home service
It's
market,
one way or the other. Yeah.
very, very resilient, also very, very resistant to inroads from AI, right? Like AI can't fix your drain,
Yeah.
like
Right.
as far as the only place I think AI is gonna get in here is really where it is now, the incoming call agent and schedule.
Yes. Right.
And whatever financial stuff, Intuit is coming out with for books. But it's very tricky. There are some competitors coming out who are making agentic agents that claim to have invoicing and estimate solutions, and
Mhm.
and it will never get there. I mean,
Yeah.
it is so complex, the needs that these businesses have on an invoice or an estimate. But again, the market's resilient. So winter is really the only fluctuation we have. And we haven't seen, COVID was like a fifth growth year for us, et cetera. So, I mean, it seems good,
Yeah. Well,
Yeah.
that is good. After all these years, you've fought for your independence. I don't know if you have any debt payments that you gotta make, but, like, there's a free and clear and, and your margins are increasing and, all of that, and, that's really exciting. I really appreciate you sharing that story with, Practical Founders here on the podcast. What advice do you give to founders in it's a little bit like the treacherousness of the new AI world transactions, there's big players, you don't know what's the infrastructure is gonna change
Right.
underneath you. Maybe they're gonna compete with you, right? There's a lot of and you're a little guy and they're huge, they're huger now, this kind of thing. What advice do you give to founders out there who, are staying off the VC funding drugs, which is most founders these days, about, let's say, surviving and thriving, in
Yeah.
the as as a little guy with, when the big guys change the rules.
So a couple things. I mean, I mean, kind of many things, right? Make sure you have some capital sources. Make sure you have an emergency capital source, and then really, really be very selective about the platforms that you are using.
Mm.
Right? Be very selective. I mean, I'd probably say, start with QuickBooks Online. I mean, we don't even use accounting software. We use Excel. That's how simple our operation is from an accounting standpoint. And then something that nobody really talks about, but I think is very important, get the right credit cards because most of the payments that you're going to be making, I'm not saying get credit cards and max them out, but we do that all the time.
Mhm.
But get the right credit cards because points matter. Right? And so
Mm.
as an example, yeah, like I think my personal favorites are all Citi, right?
Yeah.
But Amex has a great product. Amex points matter, right? I think I lived on Amex points buying groceries through Amazon.com for like through 2 years, right?
Yeah.
Get a really good airlines card. I think my favorite again is the American Airlines Platinum, which is silver or the black. We have them both. Those miles build up and that's your free airfare, right?
Okay.
You know, make sure you get and by the way,
And use
next
that for expenses to get
I
the
use
point.
them,
Yeah,
yeah,
right, yeah, right.
but don't get the cards that have 0 fees because the cards that have 0 fees, meaning it sounds counterintuitive, but the cards that you pay 400, 500, 800 in the case of some Amex cards a year, they come with way more benefits, and they accrue points faster, and those cards will approve you for higher spending limits.
Okay, there you go.
Yeah.
There's
So
practical
I'd say
funding
those
right
are
there.
yeah,
Yeah,
that's probably advice that no one's giving you, right?
yeah.
So
Well, Paul, let's talk about this. You have some SaaS revenue, but you're moving towards transaction revenue, and you have these, you say, capital providers and your debt providers. Who are these debt providers that are not so SaaS focused that you've successfully worked with through the years? Are
yeah,
they
so
banks or
right. No, they're not banks. I'd say a really good provider that we don't really get along with that well anymore is a firm called Costella Kirsch. They're located in Silicon Valley,
yeah.
and they will look at everything. The one
So creative debt providers for tech
mhm,
companies. Yeah.
yeah, and they're really good. They do take some warrant coverage, et cetera, but they're really good. And then a couple of the others that actually they don't provide the service anymore, Sandlo
Huh.
was one of the last ones that we worked with, and they are no longer doing that. So
Okay.
unfortunately, that's not a really
Okay.
great,
But
provider.
you
But
found creative ways to solve the problem and not get institutional people in your building, you know?
yes, that's
Yeah.
correct. That's
Yeah.
correct. I mean, we evaluate debt providers kind of on an ongoing basis. We haven't found. I mean, what was so great about Sandlo is that they would just look at all the revenue coming in our Plaid account. But On Deck will do that now too.
Oh, sure. Yeah.
I mean, On Deck will actually, we've done some business with On Deck in the past, and I don't even think we've submitted financials. I think they
Yeah.
took a look at yeah, I'm sure of it. Like they took a look at our Plaid integration, just saw the revenue coming in. They said,
Yeah, they
okay,
can check.
here's how much and for how long. Here are a couple options.
And are
Um,
you profitable and clear now of all that, or you're investing to grow?
we're investing to grow. As I said, we took down a $1 million debt round last September.
I see. Okay.
And we're
And you're
actually
growing.
we've just about spent it, right? So we're now looking for our next debt source, with the results that we have. But this is really our busiest period of the year from now until,
Yeah.
November in terms of marketing spend, et cetera. I mean,
Yeah.
we're cash flow positive at will
Yes,
right
yeah.
now. So if we don't spend money on marketing, we're cash flow or if we reduce our budget on marketing a little bit, we're cash flow positive. So,
Awesome.
yeah.
Great. Well, what a story, Paul, and an adventure through all of this. I don't know if you ever predicted how it would turn out, but you're, still standing and standing tall and picking up growth and, have the platform partners that you like after all these years. So congratulations on your progress,
Thank you very
Paul.
much.
Yeah.
Yeah,
Thanks for being on
thanks
the
for having
Practical
me. I
Founders
think
podcast. Yeah.
yeah, thanks for having me. Been a really great experience, and I'd also say like we're happy to be a resource. I'm happy to be a resource for
Oh,
you know
great. Really appreciate that.
anything
Payments can get
practical, founder
complicated.
related,
Right. Yes.
right?
Once you get past do want to do more than integrate with Stripe, it can get pretty complicated, right? It's a new regime for everybody. So really appreciate that. Thanks, Paul.
Thank you.
Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.